Let's welcome on board then Ajay Srivastava as well and find out what he's making of the market texture right now. Ajay, hi morning. Good to have you on the show as always. Ajay, just wanted to understand, what do you make of the strength in the mid and the small caps and the disconnect with what the large cap universe has been doing? Do you think it's getting a little toppish when it comes to individual segments, at least within the mid and small cap universe? And is it time to
You
tread
know,
with caution?
I keep saying this again and again that India is a market of flows. I think that's where we are at this point of time, that the mid cap, small cap, mutual funds are driving this market into P expansion. I don't think people are expecting them to grow very much, but the P expansion is now getting into a zone which, hopefully the festive season will give one positive surprise to us. But if it doesn't, you could have a lot of grief sitting all there. Having said that, what is also happening is, over the last 3, 4, 5 years, so many companies have come into this market which have got new themes, new industries, unexplored sectors that compared to the original concept of buying cement, bank, and those kind of stuff, steel. Now people are buying different kind of set of companies which are primarily available only in the mid-cap space. So I think it's logical that the real growth stories are going to come from the mid-cap space, because those are the new sectors, those are the new companies, and therefore they can grow at 20, 30, 40%. Their large caps may grow at 10, 15% at the best possible thing. So I think it's not only the euphoria on PE expansion, which is definitely taking place, no doubt, but also that the universe of mid-cap companies has expanded significantly. I think about 400 good companies have come into IPO in the last maybe 3 years, and those growth is kind of driving the investment. Number two is new themes. How so defense took off last year has been a persistent theme. Capital good, phenomenally good theme, is doing very well in the market. Railway security scheme took off. Couple of stocks out there went ballistic and continue to be strength. The e-com, the new age companies are coming of age, so to say, and those become a thing. So I think it's a mixture. It's a lot of PE expansion, but lots of it is going that new companies, new sectors, new age. I think, and that is what is expanding the multi-cap universe and the performance that you see today.
You're not worried that it's getting frothy at the top?
If you worry, I think I would have died long back. Okay. I don't think you worry. I think you need to worry about that. Are you in the right theme which can ride through a phase of even a deflationary situation in the market? And therefore, if you are, in my view, if you are in the consumer space, I think you need to worry yourself. If you're in the automobile space, I think you need to worry yourself. If you're in the defense space, perhaps less of a worry. If you're in the capital goods space, definitely still less of a worry. So I would not say a sectors, but I would say that if you are in the right sectors, your worries are a lot less. Everything is expensive. Now, let's be clear about it. Everything is expensive in the market. But if you want to find relative safety, I think you need to go to segments which give you safety in terms of market liquidity, in terms of performance, in terms of theme, and the old regular companies. I think the cement and the steel and the consumer. I think those are the sectors one can leave them without that. Even if they perform at best, they won't give you above debt return. So I think you need to be sector focused, company focused. Don't worry about the indices, what happens to them, because that happens. And you saw what happened to an index of indices, the BSC. What happened? Price discovery took place. The share is going up, and you see what's happening to the share price.
Ajay, hi. So clearly that's a strategy that you're looking to maintain, and some of the sectors that you did flag off, I'd like to just scratch those points further. Let's talk new age tech then. Where is it that you exactly would find comfort, or can you give us a sense as to what kind of companies, what kind of business models it is that you like?
See, we have, for disclosure, we have investment in largely three companies at this point of time. And each of them has a monopoly in its area. One, of course, is the delivery company. One is, of course, the financial services company. And one is the insurance online company. I think the three companies today straddle one of the largest segments of Indian market today. And they really don't have competition, really speaking, to a large extent. Sure, there is some competition in one delivery company, but by and large, they have now created a universe which is unbelievable and cannot be duplicated. It's like almost semi-monopoly taking place. And that's the beauty of this country, that we are a large country competitive, but we still have monopolies. And therefore that you see in whether you talk of the payment system space, one company straddles it. I don't know, maybe before your age, there used to be a thing called Godrej Almiras. All the Almiras were known as Godrej Almiras. today when you look at it and says, paisa de do, the guy says Paytm kar do. Maybe he's using Paytm, maybe he's not using Paytm, but it becomes like a generic phrase. So I think that and then insurance aggregator, this company as well as delivery company, I think represent a tracker of phenomenal value which will come from them over time. Yes, they have recovered from the valuation. Yes, they could be expensive still because they're almost at the break-even stage. They haven't reached them, but you can't take away from the ecosystem they have created. It's not going to be easy for anyone else to come in the space. And therefore, if you look at this troika of new age companies, I think they are the trailblazers of what is going to come with many more such companies joining in.
Sure. You talk about staying put when it comes to railway safety as well as the defense sectors, Ajay. But what about those who are looking at fresh investments? Do you think the time and the value on the table is not right, perhaps?
This is a constant debate we have in our office that when some of the older people come to the table for discussion investment, they say, but this share was available at this price. And the new guy, the trader, comes in and says, but you know what? I have bond today, so I need to look at today's price. I think this debate will go on forever and ever, whether, we are entering at the right price. The key point is, are you still in the segment? That is one. Number two, do you have ammunition to buy in when a correction takes place? Corrections do take place, 100% they will come. Prices, same share will be available 20% lower. The key question to yourself is, would you have the money to buy these shares when this correction happens? And I think that's where the process, it's not about whether you should buy or not. I think if you're in India, if you don't buy defense space, I think that's quite a dumb idea because for next 30 years, India's defense requirement will be humongous. The domestic indigenous policy is for there to see. Therefore, you could not, you may have a 1 year underperformance because of share price, but you won't have a 10-year underperformance or 5-year underperformance. So I would still say defense sector definitely is a plus. No matter if you don't have it, you have to enter sometime. You can't wait. Only thing is, when you enter this time, just ensure you have firepower on the side, that when the time comes, don't chicken out, buy more. When, that's the key point. It shouldn't happen that you have invested everything and you're watching. In market, only the people who survive are the people who have liquidity. If you are out of liquidity, you could be out of the market.
Do you consider yourself, Ajay, one of the younger ones or one of the older ones in the office when you have these discussions?
I always make the younger one win the debate because the older one comes with the baggage saying, oh, I saw HDFC Bank at 60 rupees IPO. I said, yeah, that was my grandfather's time. Okay, stop it. Now the guy has entered today. If you're starting your work today, you're saving today. You can't sit and say, the shares are available at this price. Live with it. This is the current reality. That's a key question is, you need to average down your holding price. And that's the most important thing. Don't leave the sector absolutely vacant and say, I will wait for a mega correction. But have the ammunition to come in and keep lowering your average price and hold some sectors over 4 or 5 years. Defense is one of them.
Talking about HDFC Bank, Ajay, what with HDFC Bank and Reliance Industries? I mean, they've just been non-performers.
See, the two different examples. HDFC Bank, I think, performed very well when it had the market regulation in their favor. No new bank licenses, no competition. RBI kept real interest rate dramatically low, and HDFC Bank ruled the roost at that point of time. So I think HDFC Bank phenomenon was part performance, but most regulatory. Today, the regulatory is different. Today, look at the number of banks. Just see 7-8 years back and today. The number of banks which have increased, about 30 odd banks have come in. The fintechs have come into play. About 400 or 500 or maybe 1,000 fintechs have come to the space. So therefore, the regulatory umbrella which HDFC Bank had, which it was portraying as if it's pure performance, has now disappeared. And the real HDFC Bank performance is now coming to the fore. And that's why investors are kind of not going to make any returns because the bank is slow. The bank is, and if you bank with HDFC Bank, I can tell you that turnover at the lowest end, which is the front end that you and I face, is so humongous that, I do not know how many relationship managers one would have seen in the last 12 months. So I think there's a huge turnover. There are huge service issues in the bank. The bank has now to compete in a competitive market. Therefore, the returns will be muted definitely. Reliance, on the other hand, has chosen to be in industries which are the worst profitable industries in the country. It said, I'm going to do geo. You can do geo, but you never made money out of it. You can do retail. Retail is an 8% EBITDA business on which you are investing capex. Now, if your interest rate in the market is 12% and your company you're investing has an 8% EBITDA business, How do you create value for shareholders? Yes, you can create scale, but can you create value? And I think that's the problem with Reliance shareholders. They're looking at a company which is growing bigger and bigger on debt, but they don't see value because the underlying business of the company, the last for 10 years, what they built up is an 8 to 10% EBITDA business, which doesn't give shareholder value returns, may give scale and size, but there are no returns for shareholders there. And I can tell you for the next 5 years, it will be the biggest underperformer again because all their investment is going into an 8 to 12% EBITDA business, and that's not going to give you a shareholder return, and not in an environment of interest rates at 12%. Certainly not.
Okay, Ajay, that's sage advice coming in. We'll let you go on that note. Appreciate you making
Thank you
time
very
for
much. You have a good day.
You too. Thank you so much for joining us today. And it seems to be a good day for the Bulls. Now, not much to complain. Of course, you